Gold is money. It is the one substance on earth that's been a reliable source of human effort and value for thousands of years. It cannot be printed or manufactured. It does not degrade. It does not rely on any trust or promises. It just is. The goal of a stacker is to accumulate as much tax-efficient gold as possible over time. But what about silver? Stick around and I'll give you my formula for using silver to buy gold. Hello everyone and welcome to Sound Money Stacking, where I help everyday people protect their wealth with precious metals. The questions I pose in this video today are: 1. Should you buy silver or gold right now? And 2. Once you have a stack, should you sell silver to buy gold? The answer to these questions lies in the gold to silver ratio, or GSR, which is the price of gold divided by the price of silver, and you may have heard of it. Plenty of people talk about it. But do you know how to use this ratio to your advantage? To do that, we need some appreciation of what is unique about gold and silver and what has happened to the ratio between their prices in the past. With this knowledge, we can come up with a plan for our future wealth preservation. Gold is the unassailable store of value, the big mama of sound money. It has been the constant throughout human civilization. Its worth today is pretty much the same as it's been throughout time. Its price changes because the value of the currencies we quote it in changes, but its buying power is remarkably stable, and you can go look up examples of this all across the internet. The reason for this is because it cannot be printed or manufactured. And while industrialization and technology has helped us to mine gold more efficiently than in the past, the world's population has also grown at the same time. So I compared the available data on the total amount of above-ground gold from the World Gold Council with the global population data from the United Nations. And you can see that there's less than 1 ounce of gold per person on the planet, and that this hasn't increased much over time. Now, if you factor in that some gold is lost to industrial use each year, then it's clear that the amount of gold per capita is pretty much constant over time. But what about its beautiful sibling, silver? It's also been used as money for thousands of years. It's just a little bit less dense than gold, a little less rare, and it can become tarnished, but it is an excellent store of value nonetheless. The problem with silver for many is that its price can be volatile, especially in recent times. Over time, the price of silver does track that of gold, but there are periods when its price has got more to do with its industrial supply and demand and the market tensions that are created. The last few decades have been an era where silver has not been utilised as a form of money in much of the world, and its industrial uses have changed dramatically. Silver has become critical to almost all aspects of our modern life: electronics, communications, mobile devices, renewable energy, EVs, defence, medicine, and so on. Its role as money is also making a comeback, with some countries now accepting silver reserves as collateral. Silver has become the critical mineral that is critical to almost everything we do, and demand has outstripped production for the past 5 years. The decades of silver price control has broken as a result, and we've seen a period of rapid price increases with dramatic pullbacks in recent months. This volatility associated with the silver repricing process makes many people think that silver is just not a sensible place to store their wealth. There is an argument that you could just buy gold steadily over time and only buy gold in order to protect your wealth, and many people do just that. If you're close to retirement or are in retirement, then this is the safest way to protect your wealth. You cannot tolerate any risk. Now, this video is aimed at those in an earlier stage of life, those of you who have an income and you can put some aside each month. or you are starting with a lump sum. Either way, you're in it for the long haul and can ride out any price volatility. Better still, you might be able to take advantage of it. So let's have a look at the gold-silver ratio. The gold-silver ratio is typically expressed as the spot price of gold divided by the price of silver. The ratio is usually calculated from the US dollar prices. This ratio changes over time due to many macroeconomic factors that influence the supply, demand, and the trading derivatives of each metal. And by that I mean things like paper futures, options, and the funds. The historical average is 29. 2 standard deviations from this mean is 51. So prices should normally revert to the mean as soon as you get that far away from the mean. However, that's not happened recently. Governments have moved away from sound money principles. Those principles are where currencies are backed by physical precious metals. The gold and silver standards of yesteryear put a cap on how much money there was for governments to spend, however. They couldn't fund their wars and reconstruction. So they developed paper alternatives which have no limits on money expansion. The value of present-day fiat currencies is derived from government decree and public trust in the issuing authority rather than any intrinsic worth. This fake money here is worthless. History has shown that every fiat currency becomes worthless over time too. The same will happen with our current currencies, and many believe that this devaluation process is accelerating quickly. The result of moving away from using precious metals as currency and the changing industrial uses of silver have shifted the ratio between the gold and silver prices. The mean gold-silver ratio in the 20th century was elevated to 49 compared to the historical average of 29. And it's been about 60 since the year 2000, and you can see this trend going up and up over time. Now, the gold-silver ratio has been falling very dramatically in recent months, with silver price increasing much more rapidly than the gold price. The gold-silver ratio was an astonishing 107 in April 2025. It has fallen quickly to get as low as 44 in January of 2026, before a strong silver pullback has resulted in the gold-silver ratio of 60 at the time of recording this video. So big changes can happen over relatively short periods. How can we use these changes in the gold-silver ratio to our advantage? Now, a quick disclaimer here, this video is not financial advice, and you should consult a licensed financial advisor when deciding what proportion of your wealth to save in cash versus precious metals and what your investments should look like. Now, what I can do is share my thought process as an experienced stacker. Once you have determined your budget for how much you want to put into physical precious metals, you need to decide how much gold and how much silver you want to buy. And this is how I use the gold to silver ratio. So here are my intended ownership targets. My secret formula if you want a clickbait title. When looking at this table, there's actually 2 different events taking place. One is the buying of your stack, and the other is the management of your stack. So you can see, as the gold-silver ratio shifts from a very high ratio where gold is far more valuable than silver, so 80 to 1 or higher, then I prefer to just buy silver. But as that gold-silver ratio falls, I will buy an increasing share of gold with my money as I top up my stack. And obviously if the gold-silver ratio falls to a very low number relative to history, then you should just be buying gold. Now, in that last column there, you can see that this is converting some of the stack to gold. As the ratio keeps falling, it's because silver is getting relatively more valuable, and it's time to start rotating some of the silver that you own in your stack and buying gold with it. You're not selling it for cash. Obviously, you get cash temporarily, but then you reinvest that in gold. Your aim is to accumulate as much gold as possible. Gold is the thing that's going to retain its value over time. History has proven it's the most stable way of storing your wealth. So the answer to question 1, should you buy silver or gold right now? Well, the gold-silver ratio at the time of recording this video is 60. Using my formula, I would buy equal values of gold and silver with the funds that I have at this time. So that's very straightforward to answer. And the answer to question 2, once you have a stack, should you sell silver to buy gold? Well, yes, at the moment. If I've already got a sizable stack of silver, I'd be thinking of adjusting my holdings at this time. I'd sell 10% of it and buy gold with the proceeds. So right now I'd probably focus on things which have gone up in collectible value or things that are liable for capital gains tax. Now might be a good time to start offloading some of those things, but it's a very small fraction of my stack. And I guess question 3 is there a situation where you would sell gold to buy silver? Well, yes, I did actually do that when the gold-silver ratio was well over 100. And I also had a conviction that there would be a breakout in the silver price in the short term. And this has proved to be an excellent call. Now, I would say that this is a rare and generational situation. And I don't expect any of the viewers in this video will see a situation like that anytime soon. So in general, no, you're probably not going to be selling gold to buy silver. Now, if you need to sell some of your precious metal stack for a sudden cost, or you're actually using it as your pension, then you can treat the gold-silver ratio in the opposite way to this table. If the gold-silver ratio is high, sell some gold first. If the gold-silver ratio is low, sell some silver first. Now, I expect in the comments I'll see a few people say that this all sounds too complicated and they'll just sell all the silver if the gold-silver ratio hits 50 or 40. They've just set a simple target. And I've seen this thinking on YouTube videos from US coin shop customers all the time. And I suspect this is mainstream thinking. I've seen it in comments on social sites too. Now, my answer to that is that you don't really know what's going to happen in the future. You can only act on the current status quo. Don't make binary decisions. Be more balanced. For example, the lowest gold-silver ratio in the last bull run in 2011 was about 32. But that economic situation is quite different to the one of today. Many analysts of long-term trends believe that the gold-silver ratio will bottom out below 20 at the end of this bull cycle for a long list of reasons. Some believe it's going to 10 or lower, and I'm probably in that camp as well. Who knows? But by shifting your allocation gradually, you can continue to take advantage of whatever happens. And here's a thought for you. If you sold 100 ounces of silver at a gold-silver ratio of 40, as many stackers are probably going to do, then with that you can buy 2.5 ounces of gold. Now, if you kept that silver until the gold-silver ratio bottomed out at 20, you could buy 5 ounces of gold. Now, that's quite a difference in your total wealth over time, as gold is the thing that's the most stable store of value. Now, one could also argue that silver will still have an important role in your stack, even when the gold-silver ratio is low. And that's because it's a very liquid hard asset. It's easy to sell in a hurry due to it having a lower value per ounce of bullion. Finally, before closing, one thing to consider is the real gold-silver ratio for you as a buyer and seller of precious metals. You are not a trader on the LBMA or COMEX exchanges. That spot price is for the big customers who are trading those massive bars that you see in the movies. Everyday stackers will be buying and selling from a reputable dealer, coin shops, or on the secondary market. And you cannot buy at spot price, and you may get more or less than spot when you sell it. The premiums over the spot price vary based on your circumstances. Silver has got a much higher premium than gold, especially in Europe and in the UK, where there are substantial sales taxes. If your budget is smaller, you'll be buying fractional sizes. These have got higher costs of production, so higher premiums. The cost of postage will add considerably to your total costs if you're just buying small amounts of bullion at a time. Overall premiums also change over time due to supply and demand issues in the market. The premiums for silver are a lot higher now than they were 6 months ago, as demand for physical silver has increased greatly. So I've got an example here where I've made some calculations. I'm not saying you need to make these calculations every time you buy and sell, but I'm just trying to illustrate the point to you. Let's say that I'm a UK stacker and I only buy tax-efficient coins from reputable bullion dealers like Atkinson's or Chards. So I've looked up the current price of buying 5 ounces of capital gains tax exempt silver and either a gold half sovereign or 1/10 gold Britannia. So these are similar values of gold and silver purchases. I considered the cost of postage in there, and I worked out the average price per ounce of some common bullion sizes for these two dealers. So if we're buying silver Britannias today from these dealers, it's going to cost us £94 an ounce on this particular day. And when we sell it, we only get £66 back. It's slightly cheaper to buy other tax-efficient silver, but there's not much difference in it. And then when we're looking at gold half sovereigns are going to cost us about £3,770 per ounce to buy, and we'll get under £3,500 an ounce back. And if we bought 1/10 ounce Britannias, the premiums on them are higher, but we'll also get a bit more money back when we come to sell them. When you work out the real gold-silver ratio when buying, it's between 47 and 40. And the real gold-silver ratio when selling is between 58 and 53. Now, the discrepancies between the real gold-silver ratio and the current spot gold-silver ratio are because of the high premiums when you buy silver. But they're also affected by the sizes of bullion that you're trading and the current supply and demand factors that influence your real gold-silver ratio. So what do you do with this information? Well, this last section of the video about real gold-silver ratio illustrates that shopping around when you buy and sell is so important in the world of stacking precious metals. You do need to figure out who has got the best prices for the sizes that you can afford. Sometimes there is a supply crisis and premiums just go crazy for a little while, and you may need to adjust your stacking formula to manage these temporary issues. So like recently, the premiums in silver just shot up, availability for some items was very poor. So it was probably a time where maybe you just focus on buying some gold and then you catch up on your silver purchases a little bit later on. So in summary, the formula that I've shared with you in this video shows how timing the market can greatly influence how quickly you build up your stack of gold. Simply by buying silver when it's cheap and then swapping it for gold when silver becomes relatively more expensive can earn you a lot of free gold. Now, I have covered the best places to look for deals in video number 8 on my channel. Do take a look at that. I also cover how to work out premiums and what might be the best sizes to buy with the budget that you have, and that's in video number 9. Now, also don't get stung with capital gains tax bills in the future. See my video number 18 for how to avoid taxes when buying and selling precious metals. Links to all of these videos are in the description. There's also a buy me a coffee link if you'd like to tip me and keep me awake. That would be greatly appreciated. Now, if this video has been helpful, please give it a like and drop me a comment and hype the video if you know how to do that. These actions tell YouTube to show this video to other stackers like you, really trying to get the word out there. Thank you for watching and see you in the next video.